European stock markets are trading tentatively higher this morning, with the UK's FTSE 100 index up around about 14 points, while the Euro Stoxx 50 index is higher by around about 6 points. US stock futures are playing catch up. The Dow Jones Industrial Average is up around about 146 points, while the S&P is up strongly as well, up about 15 points. And I'm going to remember that the US markets were closed for independence yesterday, so they will resume trading again today, and they're going to have to play catch up after yesterday's strong gains across European markets. They're going into other asset classes. The euro and sterling under pressure after dovish central banks, the BOE and the ECB now introducing forward guidance, something which is quite unexpected by investors. And in the commodity space, gold is down about $9, whereas oil is over $100, where it has remained for the course of the week, thanks to the political situation in Egypt, which has caused a lot of worries about supply and disruption of oil. And in the peripheral bond market space, Italian and Spanish and even Portuguese bond yields are relatively calm. Portugal's 10-year bond yield spiked up to 8% this week, and that was on the back of worries about the political situation in the country. Good morning, I'm Ishaq, Siddiqi, and welcome to your Daily Market Bite. It's Friday, the best day of the week, as you all know, and it's Payrolls Day. It's the big focus, as we know, at the start of every month. The first Friday, we have the US monthly jobs report, and this particular piece is going to be very important going forward, as it will ultimately decide the Fed's next possible move when it comes to tapering quantitative easing and the timeline which the Fed chooses to do so. Now, expectations are for about 160 to 180,000 jobs to be created by the US economy. Last month we had a very strong ADP figure, which is generally seen as a precursor to the payrolls, came in around about 166,000, and when it comes to the jobless claims, also a pretty strong number, and that's how the claims falling again. Now, going into the number, we're going to see a bit of hesitation, as investors are going to kind of mull over what it means for the market. If we do see a stronger number over 200,000, we're going to have to see that consistency and the jobless rate to decline to about 7.3% before investors really start thinking that the Fed is going to taper quantitative easing. On the other side, if we see a poor number, it will suggest otherwise, and we may start seeing central bank liquidity by the Fed sticking around in the market for a little longer. Now, touching on what happened yesterday, the European Central Bank and the Bank of England decided on policies. Both, unsurprisingly, kept their policies unchanged. However, the Bank of England, with Mark Carney on board, the new governor, did announce or put out a statement in which they chose their words very carefully, and they said that the Fed's intentions to taper liquidity has sent yields rising across global markets, and that's weighing on economic growth, and that's the reason why they put that forward guidance. Forward guidance is almost a prediction about the future, and the Bank of England has expressed that they will keep interest rates at record lows for an extended period. Now, interestingly, the Bank of England also suggested that although a recovery in the UK is in train, at the same time economic growth remains weak on the whole, even though we have seen very good economic data coming out of the UK this week. That said, investors have seen that as a sign that we may see some QE in the year ahead, as the BOE certainly or Mark Carney at least deems the UK economy to still be quite fragile, which would warrant the need for QE. Obviously, this is very much dependent on economic data. If we see a deterioration in the UK economy, then yes, QE is something that the BOE will consider. If not, then QE will not be an option, and it will continue keeping interest rates low for a record period. The ECB also put out forward guidance, coincidentally, at the same time as the BOE. Now, both central banks have, in their forward guidance, have expressed that they are different from the Fed in the way that they're putting their monetary policy outlooks. The ECB is a bit more of a surprise. Mario Draghi, the head of the ECB, in his forward guidance, he said that rates would be kept low for an extended period. Didn't give a timeline, whether it's 12 months, 18 months, nobody really knows, but he he's for the first time the ECB's made an unprecedented move. It was unanimous across the board, the Governing Council and the ECB, and now projecting that rates could stay low. They may look at cutting interest rates further, and that they may possibly look at other facilities such as negative deposit rates to stimulate the Eurozone economy. Now, investors saw that very dovish, because it's a dovish turn out of both central banks. It was a double team effort by Carney and Mario Draghi. Whether they discussed this beforehand or not, that's a question for the market. But the key behind this message is that although it's somewhat vague in terms of the timeline for the ECB, on the whole it does provide clarity going into the future. Investors are going to have seen that as welcome news, that we now at least know that if one central bank, the Fed, is stepping out of the quantitative easing game, at least we still have two central banks, the Bank of England and the ECB, providing support. It still has the markets back. So that's good to know, and it's enthused investors going into Friday's session. That's why we're seeing this upside. Now, going back to some of the other issues that have been affecting the market, Portugal, we're seeing a bit of a development there on that side when it comes to the government in talks with its coalition partners and opposition in order to prevent a collapse of the government, and that has helped the PSI index in Lisbon, and also at the same time it has helped yields ease off from that 8% mark. Egypt remains very much in interest for investors. Of course, Mr. Morsi was removed by the military. Now they've put in an interim government until we have new elections in Egypt, but the situation remains precarious to say the least. The economic picture is extremely weak, and Egypt is a country that's relying heavily on donations and loans, and it looks like a lot of countries may scale back those loans, or at least put on some very strict conditions for Egypt in order for the country to start paying its money back. And we've also seen the Egyptian military cracking down on the Muslim Brotherhood, the group that Mohammed Morsi, the Islamist group that Mohammed Morsi was part of. Now this crackdown could also ignite some splinter terrorism or insurgency coming through, and that is not positive for tourism. As we know, it will kill Egypt's tourism sector, hitting corporates and leisure companies and etc. in those lines. So investors are quite nervous on the whole, and more importantly, the civil unrest does not bode well for oil prices. We may continue seeing oil prices tick up. Other than that, that's it. Not much else going on. Keep your eyes on the payrolls, big number, and going into next week, I'll discuss what that payrolls number means for the market, and also we will be touching on earnings season, as Alcoa, the US aluminium giant, will report its numbers on Tuesday next week. Just watching. Thanks.